Good day, everyone, and welcome to this RMA Risk Readiness Briefing Special Coverage. My name is Stephen Martin, and I lead our Business Solutions Group at the Risk Management Association. RMA is proud to make this presentation complimentary to members. If you're not a member, you can explore all that RMA has to offer at our website, rmahq.org. We understand how busy everyone is, and we appreciate you joining us for this session. Today's webinar is the latest installment of our Credit Trends in Commercial Lending. It's part of our risk analysis service, and today's information will be based on data through December 31st of 2020. During the presentation, if you have a question for Tom or Jeremy or myself, I think you know how this works. You click on the Q&A button and submit your questions there. And be sure to do that as they come to you. That's been our practice before. We will get to as many as these questions as you have at the end of the presentation. Just a few additional housekeeping items before we get started. If you have any kind of technical difficulties, please make use of the help widget in the form of a yellow question mark. That's found at the bottom of your screen. Also, this platform is customizable, so feel free to move the widgets around to suit your preferences. So without any further ado, I'd like to turn it over to Tom Cronin from our partner at AFS, and thank you for joining today.
Thanks, Stephen, and welcome to everyone joining us today. We're really excited to share the 2020 year-end results with you, so let's just jump right in. For anyone who's joining us for the first time, a quick review of what RAS is, how long it's been around, and how banks use it. RAS started in the summer of 2003 as a reaction to the Basel II Accords that said banks must be able to benchmark their risk ratings. And from the initial 8 pilot banks and about $100 billion in outstandings, RAS now has $1 trillion in exposure, over 700,000 loans, and has been expanded to enable bank-to-peer comparisons by collateral, industry, deal size, and geographic segments. Our last webcast was right after Thanksgiving and focused on October data. So this table gives us a chance to recall what was happening before the holidays. For C&I, again looking at October versus September, delinquencies were increasing, non-accruals were still trending up, criticized was improved a little bit, and loan growth on the C&I side was down. For CRE, a similar picture for delinquencies. They were increasing. Non-accruals were also increasing. The percent criticized was increasing, and loan growth was basically flat. So now let's go take a look and see where we are as of December 2020. And we're going to start with C&I, and a quick definition. C&I loans are made to public and private companies with sales size usually greater than $1 million. These loans are manually underwritten and risk-rated, and loans secured by owner-occupied real estate fall into C&I. So this chart shows the trend in our performance measures over the past 17 years. I'd like to focus on the short-term delinquencies, the blue line, and then the non-accruals, the red line. Delinquencies, as you can see by looking at the entire 17-year timeline, are always volatile. With that in mind, let's take a look at what happened in 2020. First of all, 2020 was more volatile than usual. In fact, we haven't seen this pattern in over 10 years. You can see the M-shaped pattern in 2020 is the same pattern that we saw during the recession back in the 08-09 timeframe. We also saw a service high of 1.33% delinquencies in April of 2020. But as we said, delinquencies are volatile, and we end 2020 at just 0.28%. Now, non-accruals, the red line, are historically less volatile over short periods. And again, looking at the entire 17-year picture, tend to move in one direction. And over the last 12 months, the non-accrual rate has gradually risen from 0.73 to 0.98 as of December 20th. More recently, we've seen the non-accrual rate level off. And one more comment before we move on and examine delinquencies and non-accruals in more detail. While 2020's non-accrual level have topped out at 1.03%, that rate is still far below the service high of 3.3% we saw in late 2010. Now we're going to dig a little deeper into the delinquencies, starting with comparing the 30 to 59 days past due rate for December 2020 versus December 2019 for each two-digit NAICS codes. And frankly, the results are a mixed bag. We have a number of industries that improved substantially, such as 31 manufacturing with the subsector of food and apparel manufacturing, 51 information in the middle, and that was motion picture, cable, and telecom, 52 finance and insurance and portfolio management subsector, and then 92 public admin, executive offices, all improved. And then a number went the other way, declining. Examples of those are 21 mining, oil, and gas, the bulk of that being the extraction and support of gas activity, oil and gas activity. 48 transportation, and that's airplanes and city buses. 49 transportation, and transportation here also includes warehouses, and this is refrigerated warehouses. And then the other one that rose quite a bit was 45 retail, and that was department stores. Now, in RAS C&I, geography is based on the location of the borrower. So if a bank in Texas makes a loan to LL Bean, we tag that as a loan in Maine. And for the most part, while exact levels for December 2020 have dropped, the situation is the same from what we saw in 2019. Loans to companies east of the Mississippi are performing better when measured by short-term delinquency. In December 19, the western regions had delinquency levels well above average, and with the exception of the Northeast, the eastern regions were better than the average. And as of December 2020, the western regions are still above average, and now all of the eastern regions are better than the average. Now we'll move on to delinquency by size. And these results continue to be atypical of what we've seen in RAS over the 17 years. Normally, the smaller size loans have higher delinquency levels. But for both December 2019 and December 2020, loans above $25 million have delinquency levels well above the smaller loans. And we saw an increase in delinquencies in 2020 for loans between 10 and 25 million. So another higher segment. And delinquencies for parts, however, are way down. Now let's move on to look at non-accruals. On this slide, we're looking at the non-accrual rate for each NAICS code for December 2019 and December 2020. And it's very evident that mining, oil, and gas has been impacted the most in the past 12 months. So much so that the changes for the other industries are hard to see here. And it was suggested by several of the past attendees that we look at the data without 21 mining, oil, and gas. So let's move on to the next slide where we've pulled mining, oil, and gas. So this gives you a little better idea of what's happened over the past year to the rest of the portfolio in RAS. Let's start with a few positives and make mention of the industries that have non-accrual rates as of December 2020 that are much lower than what we saw as of December 2019. Now, last year, the highest industry was 11 agriculture. Now, the non-accrual rate for ag has dropped 76 basis points this year and is down to just the sixth highest. We also see substantial improvements for 22 utilities and 52 finance. And then that's about it for the good news. Of the 23 NAICS sectors, 12 have non-accrual rates for December 20 that are much higher than what we saw for December 2019. The industries that now have the highest percentage of loans on non-accrual status are the following. 71 arts and entertainment, now at 2.69, up from 0.74. Accommodation and food services, at 2.63, up from 151. Retail at 234, up from 163. Admin, support, and waste at 196, up from 0.85. And 55 management at 182, up from 0.33. And before we move on, I wanted to address the questions we've had in the past about 55 management. Specifically, what is it? And so I pulled the definition from NAICS.com and a couple examples of companies that are coded 55. And please note, I'm not saying these companies are in RAS. These are merely examples so you understand what's in there. So NAICS 55 companies are engaged in holding securities or equity interests in other companies for the purpose of owning a controlling interest or influence management decisions. They do not manage other companies. And examples of some of these are Allied Universal, ThyssenKrupp North America, and Pi, the HR consulting company. So now we'll move to geography. And if you recall the delinquency chart by regions, we saw high delinquency rates in the West at the end of 2020. It's a little different story for non-accruals by region. Now, the Southwest has the highest level of non-accruals, primarily because of the oil and gas. But after that, we're seeing increases in non-accruals for the eastern parts of the country. And those regions are outpacing the rest of the West. The South and Eastern Midwest are now above the average, while the West and Western Midwest are well below the average. When looking at loan size, the increase in non-accruals for 2020 hit nearly every segment for loans greater than $25 million, except for loans greater than $25 million. As I've mentioned before, what we're seeing now is not what we've seen in the past. There's very little difference in the non-accrual levels for loans of any size, particularly if you look at loans between $500,000 and say $5 million. Historically, the left to right slope of this chart was more pronounced, and as of December 2020, it's less obvious. So let's move away from performance and take a look at credit quality. When I started assembling the 2020 data, I was curious to see how the credit quality and risk ratings would reflect the volatility in delinquencies and the slow but steady rise in non-accruals. On this chart, the blue column represents December 2019 risk rating mix, the red column, the December 2020 mix. And it's very evident that we've shifted dramatically to where 5s and 6s now comprise over 50% of the outstandings. It was about 40% as of December 2019. And as a note, we've never seen such a large year-end versus year-end shift, even during the recession. So the RAS banks have moved very quickly to recognize potential problems. Now we map every bank's native customer risk ratings to the RMA 10-point scale. That scale lists loans rated 1 through 6 as pass and loans 7 through 10 as criticized, with loans 7 as special mention, 8 as substandard, 9 as doubtful, and 10 as loss. With this chart, we're looking at the trend in the criticized ratings detail. Similar to what we just saw with a historic change in the risk rating mix, we saw a significant increase in the criticized level in 2020, especially the special mention, which is the blue. For December 2019, the percent special mention was at 3.32%. It climbed to 5.45 by September and is finishing the year at 5.03. We also saw a jump in substandard, going from 2.04% in December of 2019 to now 2.76%. So let's take a look at these criticized levels by a couple of the major RAS dimensions. All but 4 industry sectors saw a rise in their percent criticized December 2019 versus December 2020. We've gone from 2 sectors above 10% as of December 2019 to 6 sectors above 10% as of December 2020. This year, we saw big increases in criticized loans for 21 mining, oil, and gas, with drilling now at 40% criticized, 48 transportation, with both air and cruise lines greater than 60% criticized, arts, entertainment, and recreation, amusement parks are now at 70% criticized, and accommodation and food services, with hotels up to 44%. Now here we're examining the trend in the percent criticized for each region, and there's an increase for every region with big jumps in the Southwest and West. And every region is now above 5%. And for the Southwest, as we sort of mentioned, we saw significant increases not only for oil and gas, but also for arts, lodging, air transportation, and management. And it's almost the same in the West, increases for arts, lodging, air and charter buses, and department stores, all industries that have a high human touch that have been impacted by the COVID virus. Here we're looking at criticized by deal size. And as we've discussed more than once today, the results are not typical of past RAS results. We're seeing very little change in the criticized level for loans under $1 million. And those levels as of December 2020 are well below what we're seeing for the larger loans. And there's very little difference now in the percent criticized for loans greater than 1 million. And big increases in 2020 has pushed the largest and participations and syndication percentages 150 to 250 basis points above the small loan amounts. And again, this is very atypical of what we've been seeing. So we want to conclude the performance and credit quality sections of this webcast with a new chart. This chart was conceived by Zions Bank and is a unique combination of performance and quality. The percent non-accrual shows you, the percent non-accrual in the red, shows you what is currently bad, and the percent special mention in the blue and percent classified in the yellow shows you what might go bad under severely stressed economic conditions. Combined, you're looking at a worst case scenario. And there are 5 industries that we have referenced a number of times today that have the highest levels on these charts. Those are mining, 21 mining, oil and gas, 45 retail, 48 transportation, 71 arts, entertainment, and recreation, and 72 accommodations. And one last C&I chart. Here we looked at the loan balance for each bank as of December 2019 versus December 2020, calculated a growth percentage, and then placed that bank in the appropriate pie slice. The red and orange slices indicate declines in balance, and 80% of the banks showed declines. On the whole, RAS C&I balances were down as the increases shown in the blue were not enough to offset the 80% declines. So now we'll move on to our analysis of CRE loans, and let's pause for a quick definition. For RAS, we define CRE as loans where the primary form of repayment is from leasing or renting that property. Now, these are often referred to as investor-owned properties. The basics for this chart are the same as what we showed starting out for the C&I review. Here we're tracking the trend in non-accruals and past dues since we split CRE into a separate database back in 2010. And starting on the far left, you see the continued improvement for all of the performance measures. This improvement continued until December of 2019, when we had or were close to service lows for all 4 measures. For instance, the non-accrual rate as of December 2019 was 0.28%. That was a service low. And the percent 90 plus days past due was 0.12%, also a service low. But over the course of 2020, the performance statistics have deteriorated. The non-accrual rate as of December 2020 has jumped to 1.14%, a level we've not encountered since back in 2014. The 90-plus days past due rate as of December 2020 is also back up to the 2014-2015 levels. And similar to the C&I results, the short-term delinquency results have been very volatile and did jump to 2.68% at the beginning of the virus-related business shutdowns. Let's take a closer look at the performance statistics here by our major property types. And again, when I say major property types, I'm looking at the balances. So these are the 8 largest property types within RAS. And we're going to compare again December 2019 versus December 2020. And the most obvious change here is the increase in delinquencies for healthcare. Retail delinquencies are also up, and we see equally significant improvements in delinquencies for multifamily and office. And multifamily has gone from the 3rd highest to the lowest or best performing as measured by past dues. So this is quite a different story from what we just saw, and it reminds me so much of the C&I non-accrual picture. If you remember what we saw for C&I, 21 mining, oil, and gas dominates the picture. For CRE, lodging dominates the non-accrual view. Just over 8% of the loans are non-accrual as of December 2020. There are some increases in non-accrual rates for healthcare, industrial, and retail, but those increases are nothing compared to what's happening with lodging. And as we've mentioned, most of the hotels in trouble cater to business travelers, and conventions. And from what we've been hearing, it might be 2022 before that business is back. As a matter of fact, just before this webcast, we were talking with Stephen about the G-Corps convention that RMA is having in June, and that's going to be virtual. And then all the conferences, the real estate conferences that were in Florida in January and February, they've all been virtual. So it definitely looks like 2021 will not be a good year for lodging. Now, this is a view we haven't created for CRE in a few years, as in the past we focused almost entirely on property type. And as a quick note, when we state geography for CRE, it's the location of the property, not the builder. Last year, the Northeast was in the middle of the pack. This year, the non-accrual rate for properties in the Northeast jumped to 2.7%. And almost all of that increase was attributable to hotels in New York and Massachusetts. And in fact, for the 6 regions that saw an increase in the non-accruals for 2020, all but the West saw huge jumps in lodging non-accruals. So the problem in lodging is nationwide. And again, similar to what we saw with C&I, the eastern part of the country tends to have higher non-accrual rates than the West. So here's the history of criticized rated loans for the CRE portfolio. And this chart mirrors what we just saw for the performance results. Up until the early part of this year, the percent criticized rates had continued to improve from just over 30% at the end of the recession to only 2.11% in March of 2020. By July, however, the rate had climbed from 2.1 to 8.9% and now sits at 7.9%. Quite high and only matched by what we saw back in 2013. Let's take a little more detailed look at the criticized trend. And here we've pulled the criticized percentages for major property types for December 2019 and December 2020. Each column has a component for the percent special mention in the blue. That's loans rated 7 on the RMA 10-point scale. And another component for the percent classified in the red. That's loans rated 8, 9, and 10. And a couple of observations. First, the most obvious is the increase in criticized for lodging, far above everybody else, pushing 40%. Second, as of December 2019, every property type except one had a percent criticized below 3%. Now, as of December 2020, every property type except one has a criticized rate above 3%. Outside of lodging, healthcare and office properties have higher percent criticized levels. And finally, the percent criticized for residential properties had the smallest change of only 11 basis points. So here's our Zions Bank design again, this time for CRE and the major property types. And again, this is the combination of the percent non-accrual in the red and the percent special mention and the percent classified, both accruing, giving you a worst case scenario. And what struck me as I looked at this is not that lodging came out to be as being the worst. We sort of knew that was going to happen. It was just how bad lodging could get. Now, we know special mention is a transient category. So even if these loans are okay and never move to non-accrual, and then just half of the classified, the yellow, end up as non-accrual, we could be looking at a non-accrual level close to 20%. And no other property type is close to that. So here's our CRE growth chart. We've compared outstandings as of December 2019 versus December 2020 and bucketed each bank into one of these four growth sectors. And this is almost the exact opposite of what we saw for C&I. For CRE, 77% of the banks had some growth in 2020, with a third up over 5%. And of the declines, no bank was down by more than minus 5%. So that concludes our 2020 review. And just to recap, again, looking at December 2020 versus 2019, past dues are down for both C&I and CRE. Non-accruals are up for both. Percent criticized is up for both, but C&I balances are down and CRE balances are up. And we'll be back in 30 days with the January 2021 numbers, and I'll hand it back to Stephen.
Great. Thank you, Tom. Really interesting to look at the year over year, and a nice way to kind of reflect back on all the things that have happened, all the ups and downs on this. Before we get into questions, I want to make a couple announcements. One is this is a great time for you to be asking anything of Tom and Jeremy, and go ahead and queue your question up. We've got a couple in the queue already, but that's usually quite informative, and we all learn from that. So please feel free there. And many of you have asked us previously about how you or your institution can access the risk analysis service. And so I'm really happy to make a couple announcements about this service. One is we've made some great strides in making it easier for your institution to participate. And then later this year, our new reporting interface will be available. And that's definitely going to be a huge advantage to everybody that uses it. And so if you have any interest in that, you can reach out to any of us, and we'd be happy to share more information. So Tom, a couple of questions have come in. Why don't we get to those? The first one, are the low level of non-accruals or other criticized levels being somehow masked by the TDR waiver that banks were operating under for the past 6 months or so?
So we believe the answer to that is yes. We had a poll question last year that asked how many people had made deferrals the first time and then the second time around. And for as best as we could gather, it was somewhere in the neighborhood of 5% or less loans that were just given deferrals regardless of what their financial condition was. So some portion of those are probably, as they come out of the second deferral period, are going to end up in the troubled area, non-accrual or criticized. I don't think it'll be the entire 5%, but it'll be some amount of those.
Some amount of those. Okay, that's good. There was a question about access to materials and slides and the recording. And as always, we make those available. Those of you that have registered, whether you attended or not, you'll get an email about how to access all those things. All right, so here's another question. Perhaps you don't have any data on this, Tom, but is there an average resolution amount on lodging loan workouts? For example, a 50% realization level based on outstanding loan amount?
We do have a little bit of data on that. So if the person who's asking that question, if you could send me your email or send the question in an email, I could get back to you with some of that information.
Terrific. Thank you, Tom. All right, folks, this is your time to ask the experts, and don't be shy. I know this is the first one of our 2021 series, so we need to break the ice a little bit sometimes. I'll give it another minute or so here as you're potentially typing up your question. Well, this was a shorter question time than we've had in the past several months, so and that's okay. I think that what it means, Tom, is you've covered everything off sufficiently and provided some good information. So thank you, both Tom and Jeremy, for sharing insights, and also want to thank everybody who joined us today. Here we go. I knew if I waited for a bit, we can get to it. How do you think the new admin will impact these numbers? I'm assuming that the question is about the president, the new president coming in. And Tom, do you have your crystal ball out, and can you share with us what you think there?
Yeah, so that's a loaded question, politics aside. And we were talking about this earlier on. The key to I'll backtrack. So we've sort of posited that there are 5 industries that are being severely impacted by the virus, and that's where most of your trouble is. And those are all industries that rely on high human touch. The method to cure that is going to be the vaccine. And I don't know where you live and what your experience has been, but as we were talking with Stephen earlier, we're in Pennsylvania, and the rollout is not going very smoothly. And until people get vaccinated, I don't see those industries that are being impacted, the hotels, the buses, the restaurants, the retail stores, the gas, because people not driving. I don't see those coming back. So if the new administration can get those virus vaccines out faster, I think you'd see some of this data turn for the better. If they continue to have problems, it's not going to be anything pretty for a while.
Yeah, I think you're probably right on that, Tom, unfortunately. Question about the data. Is data available for the Canadian market in this service?
At this time, there is not data available for Canada.
I think the keywords there at this time, as I kind of announced, we're making this platform available and easier to implement for a larger number of institutions. And I very much would love to see our Canadian institutions be participating in this. All right, now we're getting a few more questions, which is terrific, folks. Keep them coming. Karen asks, are you surprised with healthcare delinquencies, both on the C&I and CRE front, and what could possibly be driving those delinquencies?
So the first answer is yes. When we initially saw this, I was surprised. And then there's another question coming up right after. When we looked into what within healthcare was having problems, it was kind of like, oh, I understand now. So part of what's in healthcare are the nursing homes. And as you know, at least from what I've seen in Pennsylvania, the nursing homes are one of the hardest hit areas. People died, and a lot of those beds have never been filled, and people that were supposed to go in there never filled the beds. The other thing we saw is that a lot of the primary practices Initially, people weren't going in for regular checkups, or they were doing all virtual appointments if they were doing anything. And so a lot of the traffic in a doctor's office, in a dentist's office, even eyeglasses, those industries, those subsectors within the healthcare were having problems.
That's all very understandable. I think you're right on with that, Tom. And yeah, so you've covered off Kenneth's question as well.
Right.
Good.
Yeah, the healthcare, just so people are online understand, it covers not only hospitals, but also the ambulatory services and the doctor's offices, and then the nursing homes, things like that.
Okay. Well, it looks like we've run now our course on the questions. So I'll go back to giving a big thanks out to you, Tom. And Jeremy, I know you were there standing by in case things got tough, so I appreciate that as well. And all your insights month over month have been very valuable. And for those of you who have joined us and for the first time, I'm glad you're here. For those of you who have been repeat attendees, we welcome you back and glad that you're on the call. See, if I just delay enough, Tom, another question comes in. Can you discuss your data set used in your analyses, the number of banks, size, geography? You actually have a couple good charts on here, and this person may have joined a little bit late.
Yes, so I think if you're asking what comprises RAS, so there's a number of banks in the service. They are primarily what I call middle market and above. The database itself has around $1 trillion, and it covers, it's a fairly pervasive from a national standpoint, with maybe some exceptions in the Western Midwest. But we have good coverage in the Atlantic seaboard, across the South and up the West Coast, and then in the heartland as well.
Yeah, I'm thinking of a Western or a Western Midwest bank that asked you that very specific question recently, and it was nice to be able to report back the complete coverage in that bank's all their geographies and all their markets. So it does seem to span, like you say, all across the U.S. and across all these different industries.
Right.
All right. Well, I'm going to call it at that. So be sure to look for our next session, which will be next month. We'll be reporting on the January month-end data, and you can register for that on our website, rmahq.org, in the events area. And I'd also encourage you to consider joining us for our upcoming RMA webinar, which is all about optimizing your institution's industry research and benchmarking process. And that's put on by our statement studies team. That'll be Friday the 5th at 1 o'clock Eastern. And that concludes our webinar. So at the conclusion of this, there will be an opportunity to give us some feedback via a survey, a post-event survey. And we read that very carefully, and it helps us make this better. So if that pops up, please take a minute or two and give us some feedback. And thank everybody. Have a great day.